Well, hello, everyone. I hope you're doing well. I hope you're enjoying some of the nice days that we've been having. This week's topic is understanding the Fed's recent actions. So during these difficult times, there have been many actions taken to support the U.S. economy. One of the agencies that has taken some actions is the Federal Reserve, which is the U.S. central bank. The Federal Open Market Committee, otherwise known as the FOMC, which makes many of the Fed's key decisions, has made a promise to buy Treasury securities and agency mortgages that are backed in the amount necessary to support the economy. The FOMC is also trying to prevent disruptions in the financial markets. In addition, the Fed is purchasing corporate as well as state and local government bonds and providing loans to the private sector. It will buy corporate bonds from U.S. companies themselves. It should be noted that these bonds will still have to be repaid. Just because the Fed is buying the corporate bond doesn't mean the repayment has been forgiven. This is not a corporate bailout. The Fed's goals is to provide liquidity and facilitate borrowing for corporations, as well as setting the stage for an economic recovery. By purchasing Treasury securities, the money supply is increased throughout the broader economy. The purchase of mortgage-backed securities aids the mortgage market, along with setting interest rates. The Fed aims to promote employment and maintain prices. Well, this is it. This is its dual mandate. All of this has a familiar name, quantitative easing, or QE for short. The goal of this is to increase liquidity in the economy. The purchases are done through banks within the Federal Reserve System. Purchases are done by adding dollar amounts to the individual bank's balance sheets. This is actually done electronically. They don't actually print real paper money. Now the bank has more money to lend. Also, when the Treasury or mortgage agency issues bonds, the Fed is ready to buy. This is one way the Treasury finances its stimulus programs, such as those passed under the CARES Act. By holding these securities, the Fed will earn interest. Any net interest the Fed earns is returned to the Treasury. This equates to an interest-free loan on Treasuries, however. The principal is paid when the bond matures. Essentially, the bond becomes part of the national debt when they mature and the principal is due. The Treasury issues new bonds and the debt payment is just kicked down the road, which we've been doing for quite a long time now. Given that the Fed has created money endlessly, why doesn't it always do so? Well, there is an endless need for government to spend and for other lending. The reason it only uses this tool in select circumstances is inflation. Too much money in the economy will raise the price of goods and services as consumers compete with each other to purchase those available goods. Now, an example of this happened in World War II and during the 1970s. Now, during these times, there was a low interest rate environment, like today, and money was pumped into the economy by the Fed, like today. This resulted in high inflation rates. The situation today, however, is a little bit different. The inflation rate has been low over the last decade or so. In the current situation, consumer spending has been severely impacted and people just started spending like they did before the pandemic. It seems unlikely, at least in the near term, that inflation will rise, but it certainly could in the future. Now, what happens over the long term might be a different story. The Fed will attempt to increase the money supply just enough to ease the crisis. This action can be seen in the amount of Treasury security purchases. So back in the weeks of March, the last week of March exactly, purchases were at a peak, $75 billion per day. By mid-June, it had leveled down to about $4 billion a day. Adjustments can be made anytime the Fed thinks it is warranted.